Is the RSI over 70 an exit signal for long positions? Just a little bit of a revision in terms of the RSI, or relative strength index. As with all indicators, the RSI is based on calculations related to price action. It's an oscillator which looks at velocity as well as the price move, and its aim is to determine whether something is overbought because it's moved too far to the upside, or oversold where it's moved too fast to the downside. Quite simply, key levels are 70 and 30. If there's a move over 70, it's deemed overbought, and in which case we tend to avoid entering new long positions. If there's a move below 30, then it's classed as oversold, and we should avoid entering new short positions. So in practical terms, let's look at considerations if potentially using the RSI as an exit. So logically, if we are in a long position, it seems like a worthwhile question to ask is if that trend move moves into an overbought situation, should it be or could it be used as an exit signal? Because the RSI is calculated using price and velocity of a price move, then what happens subsequently, traditionally, is that if something is overbought, at best it will pause in terms of price action, at worst it is likely to be subject to selling pressure. So your options would therefore appear to be to exit when it hits overbought or drops from an overbought situation, or take it as a warning sign and tighten a trail stop. Two key questions to ask yourself is, what is the reason behind any strong move? If it's based on, say, a corporate action in a share price or significant alteration in data in some of the other instruments you can trade, then perhaps that's the underlying reason. Therefore, perhaps this overbought, oversold situation is justified to some degree. And the second question to ask yourself, and ask yourself this of the trades that you've taken previously, what am I seeing in previous trades that I was in that reached an overbought situation? In essence, ask the question, if I got out or trailed tighter, would my outcome have been any better? Just for absolute clarity and to finish, let me just show you a chart of what we mean. So here we have a GB pound US dollar on an hourly chart. You can see there's a fairly healthy uptrend after a double bottom formation there. But you can see here it hits overbought at this point here. So at this candle here, it appears to be overbought. So if we'd stayed into this until it started to drop again, which would be this point here, we will be out at this point, and a good exit, and way before any price crossing the 20 EMA, for example, as a trail stop would be triggered, and hence keeping more of our profit. If we look at the next trend, which essentially is a breakout trade, again, exactly the same happens. If we look here, say we got in on this candle here, well under 70 on the RSI, moves up, and at this stage here, you can see it moves above 70, and therefore we are out of this trade, meaning that we are getting approximately an extra 4 or 5 pips on this particular time frame for exiting on that as a potential criteria.